Hey, welcome back to Kyle's Financial News. I am your host, Kyle. Today's date is Wednesday, June 26th, 2024. In today's market, Amazon broke the $2 trillion market cap threshold. It is just multi-trillion dollar companies everywhere these days. Microsoft, Apple, Nvidia really kind of showed up out of nowhere to take some titles and put up a fight. And Amazon is saying, hey, I'm not going to be left behind here. I'm still in it to win it. Amazon has been trying to push up against that $2 trillion market cap threshold for a while now, and finally today it made some significant progress. And I think that might be a good portion of what kind of held up our markets today. We ended up just going a little bit sideways. Nvidia didn't really do too much, sold off just 1 or 2% or so. Not a lot of action going on. GameStop is not really doing anything fancy. Like, there's no big news announcements aside from just monitoring market caps. Apparently those numbers are only going to increase just indefinitely. Even if we maintain a 2% annual inflation target, that number will just continue to go up. People make more, things cost more, people invest more. That's just a numbers game. Really not any significance to a market cap total necessarily in the first place. It's not like, oh, because a company, Amazon, hit $2 trillion, now I'm going to make investment decisions based on that. It's just a number at the end of the day. Another really interesting thing that went on today is these bank stress tests. And if you're not familiar with these bank stress tests, they are operated by the Federal Reserve. And what they are is mock scenarios or kind of virtual environments where these banks are put under duress or simulated to be acting as if they are operating during times of macroeconomic bad situations, and determining whether or not how much cash that they have on hand, how much debt that they could possibly take on, and how much loss that they could potentially unrealized or realized face on their balance sheet. Would they still be solvent? And so I wanted to go through a couple of those talking points that I was reading about through this article and see what you guys think about that. So the 31 largest U.S. banks that participated in a Federal Reserve stress test would all be able to withstand a severe global recession, a new demonstration of strength as they push back on stricter regulations that would require them to hold more capital. So the banks, by passing this stress test, are demonstrating a strength as, in the meantime, they are pushing back on stricter regulations. My understanding is that banks today have virtually no regulations at all on how much capital that they are required to be holding. As far as I understand, banks at the moment, as of just a couple of years ago, now have to hold 0% of their deposits to be able to just be ready with on hand. It used to be 10%. They used to be able to hold 10% of all deposits into in their accounts and not be loaning that out or borrowing against it. And then it was made 0% because this was going to help banks more easily loan out and keep the economy churning and not create any risk on the bank's end at all. So yeah, 31 of the largest US banks passed this test. So let me share with you some details about this. Results released by the Federal Reserve today show that these banks would have enough capital on hand to absorb losses and continue lending during a 2-year scenario where the US unemployment climbs to 10%, commercial real estate prices fall 40%, and the stock market plunges 55%. Now, that certainly does sound like not a great scenario. And I'm going to circle back around to that here shortly. So let me read you this quote from Michael Barr. And Michael Barr, if you're not familiar with him, he is a Federal Reserve member. He is the vice chair for supervision. He said, "The goal of our test is to help to ensure the banks have enough capital to absorb losses in a highly stressful scenario. This test shows that they do." That's what he said. Now, furthermore, a law passed in 2018 tailored these tests based on the bank's size, meaning those in the range of $100 to $250 billion or so would be the ones tested every other year. Some Democrats and regulators last year were critical of that 2018 adjustment They argued it could have helped prevent the problems that amassed at Silicon Valley Bank, which I covered them in my Why Banks Fail recently video, which had not been subjected to a stress test before it failed in 2023. So Silicon Valley Bank must have just been barely below that threshold to be able to bypass the need of being tested. And lo and behold, look what failed. Look what caused the Fed to have to increase their balance sheet by billions, tens of billions of dollars. Look what caused a total panic and run on a bank with Silicon Valley Bank and then the few others. And the FDIC had to step in, and there was talk of who covers the accounts with balances that go beyond the insurance. That was no small deal. So clearly there might be some changes to who qualifies for the test in the first place. Now here was the really interesting part that I found out about this article. Banks typically use the results of the annual Fed stress tests to determine how much they should have on their balance sheet to absorb shocks and how much they have left over for dividends and buybacks. So let me get this straight. This test not only shows these major banks, the top 31 banks in the US, how much money that they would need to qualify as a pass for these very specific kind of calculated scenarios that apparently have no worse possible outcome than what has been defined as kind of the basis of the stress test. But then on top of that, the bank just says, oh, okay, well then we'll draw the line there, and everything after that, all the money that we still have in our account sitting there after that, we're going to pass out as dividends and kick back to our shareholders and do stock buybacks and just continue to make the company itself more valuable, not necessarily more profitable. They're not bringing in any more money. They're not changing anything about their core business practices or their revenue streams. They're just simply trying to increase the valuation of their share price. Some banks are expected to make announcements late Friday about how much money they now plan to return to shareholders. Now, if you're shareholders of some of these big banks, sure, great. You're going to get hopefully a little bit more appreciation in your shares. But I suppose my only concern is, what if these banks face a scenario where unemployment is more than 10%, real estate prices fall more than 40%, and the stock market plunges more than 55%? As bad as that scenario sounds, it doesn't sound possibly entirely out of the question. I suppose to me, a doomsday scenario would be even worse than that. And let me tell you why. In 2007, home prices fell over the next 2 years 32% on average. And if we can recall and look back at what happened in 2007, 2008, 2009, that housing bubble, the crash with the junk loans, who had to step in and save the day because the banks weren't capable of surviving on their own? The Fed added just a little bit over $2.5 trillion in assets to their balance sheet between those years. And so one might suggest that, well, that's why they came up with the bank stress test. And that's why we're doing bank stress tests. Well, okay, that might be a fair argument. We didn't start doing bank stress tests until 2018. And this was a 2007 to 2009 housing crisis, housing bubble. And so now that we have the stress tests, now we can properly prepare for that. Well, here comes COVID. Here comes the pandemic. Unemployment spiked to 14.8% in April and March of 2020. So much for the 10% unemployment scenario, because we just recently had a 14.8% scenario. And what did the Federal Reserve have to do during COVID? The Fed added $4.7 trillion in assets to their balance sheet. So we're talking the 2008 housing bubble times 2. We saw unemployment spike to 15%. We saw the stock market fall about 35% in March of 2020. And the Fed printed us right out of that March 2020 dip that we were seeing on indexes. We were falling between 1 to 1.5% a day. Consistently. We were just stair-stepping the whole way down. I remember those days watching the markets vividly. But now we're supposed to trust that, oh no, it's completely different now. See, if it was only these very precise definitions of what makes up a crisis, then the banks would survive fine. Well, what we know from history is that hardly ever are these precise conditions the conditions in which the banks are faced. So why are they not held to a higher standard and forced to hold capital that would be able to survive a scenario maybe at least twice that? I don't know. That's just my hot take on that. It gets me a little bit riled up because banks already don't have to have virtually any capital in the first place on hand. So now we're just further kind of digging the hole of letting them do whatever they want. And if they can pass this little very specialized calculatable test, then all's good. And who's going to bail us out when this horrible day of dread comes and these conditions end up being not even close to what ends up actually happening, and banks start to fail and everything starts to really fall apart? People can't withdraw their money. You might be able to guess it. The Federal Reserve is going to start adding trillions and trillions and trillions of more dollars in assets to their balance sheet, and just acting as a parachute that will just never ever land us on the ground. We're still trying to undo the damage from the 2008 to 2009 crisis, and now we have the COVID and the pandemic crisis damage on top of that. Now, a fun little fact I'd like to share is that my subscribers are up 10.52% overnight. If you've liked this video so far, please consider liking and subscribing. Invest in me, and I will continue to provide this type of content to y'all. Thanks so much. Otherwise, what we are looking at headline-wise in the markets today is yen making a new low. Yen is super weak lately. It has been having a horrible, horrible time. Japan's economy is struggling. They're needing to really figure out their issue with their currency and bring value back home. So the yen is now 160 yen to an American dollar, and just 4 years ago it was only about 107. So they're looking at almost a 50% decrease in value to the United States dollar just in the last 4 or 5 years. They are really struggling over there. Also, in the crypto world, supposedly we might be looking at a Solana ETF very soon. There is some progress trying to be made in Canadian markets, and that might just be the tipping point that opens the door for American markets. And we know we have now Bitcoin ETFs, we have Ethereum ETFs. It may not be very much longer before we're looking at like an XRP ETF, a Solana ETF. A number of these high cap cryptocurrencies might be looking to get into the ETF space. Very interesting stuff. I really like Solana. They've got a killer network. They've got a really strong grip on the NFT market space. They're really doing some innovative things. So I'm excited to see where it goes from there for them. Leave a comment down below on your thoughts about that Fed stress test with the big banks. I'm curious to hear your thoughts on that. Thanks again, and I'll catch you all next time.